International Business Machines ticker IBM is currently trading at $122.02, and over the past month they are down by almost 6.5%, and over the past 6 months they are down by almost 15%. Now if we have a look at the maximum graph, we can see that the stock price has been falling steadily since 2013 to the current date. Now in this video we will have a look at the reasons to why the stock price has been falling over the long term, but before we do that we will quickly jump to the monthly fall and have a look at what IBM is planning for the near future. IBM is currently working on its cloud ecosystem expansion, and they believe that that is what will drive their long-term growth. IBM is currently one of the very few firms focusing on the hybrid cloud, which allows them to dominate this field without going head-to-head with other dominant cloud infrastructure platforms such as Amazon Web Services and Microsoft Azure. Now, as the world is currently transitioning into the AI era, firms that have a head start in this sector will with no doubt dominate the market, and I believe that IBM is one of them, and therefore might be a great long-term investment. But today we will have a look at the current situation of IBM and find its intrinsic value based on their financial metrics. And to do this, we'll jump over to my fully automatic stock valuation spreadsheets, where we will have a look at the 9-pill analysis and calculate the intrinsic value of IBM using the Grams formula revised, discounted cash flow model, multiples valuation model, and the dividend discount model. And all these models will lead to our ultimate valuation at the end of the video. Now to jump back to the stock screener, we will plug in the ticker IBM and all the metrics will show up automatically. And right away we can see the very nice dividend yield of almost 5.5% and the dividend payout sitting at $6.64 per year per share. Now the payout ratio is sitting above 350%, which is concerning, and I will get into that further in the video. Now the institutional ownership is sitting at about 60% and the beta of IBM is sitting at 0.85, which means that with IBM you will see less volatility than with the overall market. But now we can jump to the 9-pill analysis, where I have already plugged in the ticker, and right away we can see that the revenue, free cash flow and net income have all been decreasing over the past few years. Now if we scroll down to the financials, we can see this in a bit more depth. So we can see that in 2014 the net income of IBM was sitting at about 12 billion, and in 2022 the net income was about 1.5 billion. Similarly with the revenue, which has decreased from 92 billion in 2014 to 60 billion in 2022. And finally down here we can see that IBM has actually been raising their dividends quite steadily over the past few years, which would generally be quite good, but in this case that is the reason for IBM's very high payout ratio. Now if we scroll back up, we can see that the 5-year profit margin of IBM is sitting at about 53%. There are decreasing shares outstanding and the price to free cash flow is sitting at 9.54, which is a very decent number. And the long-term liabilities of the 5-year free cash flow negative dividends is sitting at 2.53, which means that IBM can pay off most of its debt while paying out dividends in about 12.5 years. Now, even though most of the metrics here are in the green, the fact that IBM is not growing their income is a big red flag for me. But now let's jump to our first valuation model, where we will use the Grams formula revised to calculate the intrinsic value. So first we'll plug in the ticker IBM and all the metrics will show up automatically. Now to calculate the intrinsic value, we'll take the earnings per share of IBM and the 5-year growth estimate, which we will multiply by the average yield on AA corporation bonds and then divide everything by the current yield on AA corporation bonds to get an intrinsic value of $47.51, which is about 157% lower than the current trading price. Now, one of the main reasons for this huge price difference might be the current yield on AA corporation bonds, which is currently sitting at about 4.6, but over the long term, the average yield on AA corporation bonds is about 3.4. So if we plug that in, we can see that the intrinsic value rises to 64, and the difference now is only 90%. Still a big difference though. But now let's move to our next valuation model, the discounted cash flow valuation model. We will plug in the ticker IBM and the free cash flow over the past 10 years will show up automatically, calculating the average growth rate to be at negative 3.92 annually. Now, as I want to be very cautious, I project a growth rate of 0.7% over the next few years. And using this growth rate, we will calculate the future free cash flow over the next 10 years. Now, to calculate the present value of that future free cash flow, which we will use to move forward with this valuation, we need to calculate the discount rate. And we do that using the WACC and the 9-pill analysis we have done prior. And I calculated the discount rate to be at about 7%. So we will plug that in. And as you can see, we sum up all the present value of that future free cash flow we calculate, add any cash and cash equivalents, subtract total debt, and get an equity value of 133,785, which we divide by the shares outstanding and get an intrinsic value of $147.33. And this is quite higher than the current trading price, even with the very low projected free cash flow growth rate. But now let's jump to our third valuation model, the multiples valuation model, which is based on comparing firms that operate in the same sector and have similar structures. In this case, I will be comparing IBM to INFY and ACN. I took these companies' current stock prices and divided by their current earnings per share to get their price to earnings ratio. I then averaged out that PE ratio and multiplied by the current earnings per share of IBM to get an intrinsic value of $43.59, quite lower than the current trading price, which suggests that IBM is quite overvalued compared to the firms that operate in the same sector. But as I've mentioned before, IBM is currently mostly basing their businesses around their hybrid cloud systems, which might be one of the main reasons for the low intrinsic value. And this is also why we will altogether remove the multiples valuation, as currently IBM cannot be directly compared to any of its peers, and it is better to leave the whole valuation out than to calculate an inaccurate intrinsic value. But now we can move to our final valuation model, the dividend discount model. I will plug in the ticker IBM, and all the metrics will show up automatically, giving us the dividend payout over the past 5 years and calculating the average growth rate to be sitting at about 1.26% annually. Now I project a growth rate of only 0.5%, as I do believe that the decreasing income of IBM will force them to lower their dividend growth. Now we will plug in the yearly dividend frequency of 4, as IBM does pay out its dividends quarterly, and we will calculate the next year's dividend using the projected growth rate. Then we will take the next year's dividend and divide by the WACC negative the projected growth rate, which will allow us to arrive to our intrinsic value of $121.33, only slightly lower than the current trading price. Now we can move to our final valuation, where we will average out the Graham's formula discounted cash flow model and the dividend discount model to get an intrinsic value of $110.04, about 10% lower than the current trading price. Now if we were to plug in a margin of safety of 10%, that would give us an acceptable buy price at $99.03. I currently do not own this company in my portfolio, and I will not buy it until its price goes below $100, as I believe that it is quite risky to buy it at its current price. Now if you find these spreadsheets helpful, you can go check them out in my Patreon at the link in the description. With that, if you enjoyed the video, make sure to leave a like and consider subscribing, as it really helps the channel out.